analysts is China's 7,000-year-old strategy to acquire gold for pennies on the dollar. The financial press has barely scratched the surface of China's gold hoard. The real secret to their gold accumulation will one day shock the world. The Chinese aren't the only ones using this strategy. So are some of the wealthiest investors on Earth, accelerating their gold accumulation with one of the oldest businesses known to mankind. Learn more about China's real gold accumulation strategy at futuremoneytrends.com/China strategy. Greetings and thank you for joining us at futuremoneytrends.com. I have a special guest for us today. If you're feeling a little uneasy about the markets right now, if you're starting to get a little bearish or concerned about another 2008 crisis, my guest today is going to take you right over the edge. Literally. He's the author of Demographic Cliff, Harry Dent, editor of the free newsletter, Economy and Markets. Harry, thank you so much for being on the show.
Thank you.
I want to start by letting our audience know that by visiting harrydent.com, you can actually receive a free copy of his recent book, The Demographic Cliff. Just chip in for shipping and handling. Okay, so everybody is interested in the markets right now. Even if you're not a participant in the markets, I'm getting texts and messages from all sorts of people in my life. So Harry, I'd really like to talk about the near term. What's happening right now? How does it fall in line with your demographics and your forecasts and projections? And is this a 10% correction, which the mainstream media is really pushing? Or is this something larger and grander in the works?
We've been predicting for decades that by 2008, we'd be in a slowing economy. And that's why we have endless QE up until recently and 2% growth at best, in response to that. Baby boomers are done, and they're the largest generation in history, and there aren't really, the next generation for the first time in history will only be about the same size or a bit smaller. So you've got a dilemma that we're already seeing in Japan. Their baby boom peaked back between 1990 and 96, as we predicted. We were the only people that saw the collapse of Japan when they looked like they could do no wrong. And they're still down. Real estate's still down, 25 years later, and their economy is still very, very sluggish, despite 3 times the quantitative easing that we've done, because they have older people dying now faster than younger people are coming along and buying homes and spending money. So this is a big deal. And once in a lifetime, we get what I call a bubble burst, a credit bubble and financial asset bubble. It bursts like the Roaring '20s bursting in the 1930s. And that's what we call the winter season. That's when you get deflation in prices, deleveraging of bubbles. And the problem is when that happens, everything goes down together. Stocks, commodities, real estate, you name it. Everything but the safest bonds. And in this case, like in 2008, the reserve currency, the U.S. dollar, goes up. So this is not a correction. And we've been warning about this. We've been telling our subscribers, get out ahead of this bubble. Don't wait until it's obvious like now, because the markets get very volatile. And the first wave down in most major bubbles in history tends to be 30, 40% or more. The tech bubble was down in the first 2.5 months, the NASDAQ, 40%. The 1929, when that bubble finally first burst in the Dow, 46% in the first 2.5 months. And we just saw China demonstrate this exactly. China bubble burst. We were warning about it. It burst 35% in the first 3 weeks, and 2 months later, it's still going down. It's down 42% before yesterday's bounce. So this is what happens. So we telling people, use times like this. The markets are bouncing. They might bounce a little more. It gets harder to predict, but use bounces in the market to get safe, to protect your capital. We see the markets on and off being down into 2020 to 22 before our demographic trends turn up. Again, we've been saying that forever. And again, I think the most dangerous time is the next month and a half, because mid-August to mid-October is the crash season annually. When you do see major crashes, that's the time you're most likely to see the strongest down moves. And our cycles point down into late 2016, early 2017. So we think we're going to have another 2008-like crash. It's just going to be bigger now that we've kicked the can down the road with all this artificial stimulus, and we've created a whole nother bubble. All this money, $4.5 trillion from the central bank, the Federal Reserve, and then 10 to 12 trillion around the world. All of this has just gone into speculation. Companies major companies have been using free money, near free money, to buy their own stock to make their earnings per share look better. Governments around the world are using free money created out of nowhere to buy their own bonds and suppress interest rates and make money free. I mean, a 2-year treasury with average 2% inflation is 2%. That means the money's free, adjusted for inflation. Short-term rates, the Fed is set now for 6.5 years, at 0. Money is free. When money is free, it will be abused every time.
Now, is that inflationary by definition, the free money? However, my assumption is that the deflation, the natural forces of deflation of just economic science, is too overwhelming for the Fed right now.
Yeah, that's what people need to understand. All the gold bugs, I have to argue with them all the time. They're smart enough to know we got a problem, but they don't understand what happens when a debt bubble deleverages because they don't study history close enough. Money that's been created, all this money printing, it hasn't gone into lending capacity because consumers already overborrowed in the boom. Businesses already overexpanded in the boom, and China has overexpanded 10, 12 years in advance. So you've got all this excess debt, excess capacity, so the money ends up going into speculation. All this money goes into the economy, and hedge funds leverage it up 20 to 30 times, and you know, all it does is create bubbles. So we're not getting consumer price inflation, which we normally would. If you created all this money in normal times, you would tend to get consumer inflation because it would go into the banking system and it would be, you know, money would be lent out and it would create more money chasing goods. It's going into financial asset speculation. So all we get out of this is bubbles. And bubbles do one thing every time in history. And every time I get on TV or something and I say the Dow could go to 5,800 to 6,000 in the next year and a half, and this bubble, it's a bubble, it's going to burst, and people say, oh, it's not a bubble because of this, not a bubble because of that. I'm like, this is a bubble. Look at it compared to the 1990s. The Dow and S&P look almost exactly like it did back then. It's a bubble, and it's going to burst. Bubbles only burst. And if anybody can find me a stock market or a commodity market or gold or anything else that went up exponentially in 5 or 6 years and didn't burst, I'd like to see it because I've studied all the history. It doesn't happen. So this is a bubble. It's going to burst. That's why investors have to get out of the way. This is not a buy and the hold. This is not a buy the dips market anymore. You've got to protect your gains in real estate and in stocks and anything other investments you have before everything crashes, because the market and the economy want to deleverage. They want to get rid of debt. Debt's now 230 trillion around the world. 100 trillion that's going to disappear like it did in the 1930s. Stocks need to get back down to earth so that the young investors can invest again. You have no chance of making money buying stocks at these high levels. The best models show you'd be lucky to make -1% to -3% a year over the next 10 years, given how highly valued stocks are. So we need this whole thing to delever. You know, it's kind of like a financial detox, and it's painful. And all you have to do is look at the 1930s to see how painful it can be. But if you do get out of the way, and if you are in cash and have cash flow investments, everything will work to your advantage. You're going to be able to buy financial assets, real estate, stocks, companies, gold, anything at 10, 20 cents on the dollar in the next several years.
Now, in situations like where commodities have just been in a severe bear market for the past 4 years, a lot of these commodities, they're trading for less than the cost to produce them. Let's mention gold specifically, platinum. You know, I was looking at like a platinum palladium mine. They only pay these guys like $450 a month, and they can't generate the cost of capital to produce these commodities. Does that play in at all, or is it just, again, it doesn't matter about supply and price discovery right now because there's a wave of deflation, and a lot of the demand that is currently priced into the commodities was fake anyway because it came from places like China and the U.S.
You know, it's still supply and demand because businesses around the world, not just us, overexpanded in a boom that looked like it would go on forever and was highly leveraged by debt growing at 2.6 times GDP in the United States alone. And now demand globally is going down. I mean, the biggest joke in the world is that China says they're growing at 7%. This is not the case. There's no way iron ore would be down 80%, and oil and coal down 70% if China was growing at 7% because they're the largest consumer of commodities, both their consumers and their industrial machine. China is probably growing at 3 to 4%. China has overbuilt everything, condos, houses, roads, infrastructures, industrial capacity, 10, 12 years out. They've moved 500 million people in the last 25 years to cities, and half of that in the last 12 years. They've got 220 million unregistered citizens with no skills in cities, and now that they're produce something for nothing economy, I mean, they're building stuff for nobody, is starting to collapse. This is going to be a huge problem. So we've overexpanded, too much supply. Now global demand goes down, led by China, also generated by falling demographic trends in the whole developed world. And China's collapse kills emerging countries where there are good demographics. And so you have this commodity collapse, and it's going to continue. And you're right. Our biggest thing is, hey, emerging countries around the world are already hurting from this collapse. And then, like you say, prices falling below production costs. Look in the United States and Canada, the frackers are going to get killed. They're $65 on average cost, and oil is sitting at $38, $40 recently, and it's going to go to 10 to 20 before it's over. They're going to have to default on their debt. They're producing now because their short-term variable costs are maybe $15 to $20, but their long-term costs are between $50 and $80, and they are losing money, and they're going to default on over $300 billion in debt, and that's going to be the beginning of our next kind of debt crisis in the United States. That's our next subprime crisis. So that's how commodities affect us, even though outside of oil and fracking, we're not major commodity exporters as a general rule. But think what this is going to do to Venezuela and Russia and Iran and even Saudi Arabia. Saudi Arabia is at $7 cost. So Saudi Arabia is losing money on their government side, but they are still make money on the business side, and they want the frackers to go under. They want 4 or 5 million barrels of oil a day to disappear in the United States so that supply comes back down and they have more market share. So Saudi Arabia is pumping when they shouldn't, but they're doing like Rockefeller in the early 1900s, where they're saying, look, we're the lowest cost producer. We want to wipe out our competition.
Now, if I'm in power or even a central planner, you look at what you've just pointed out, and obviously a collapse like this will be devastating to government revenues. The debt will be just crazy. So I would imagine their response, and I mean, please expand on why isn't the Fed going to just overwhelm the system with helicopter money?
Yeah, I think that, I've been saying this year, I don't think we're going to see a rate hike. Everybody's debating, is the rate hike going to be September or December and all this ridiculous, stupid stuff, like a quarter of a point will make a big difference. I haven't seen a rate hike. We felt that markets would be down and economies would be slowing in the second half of 2015. And I would not be surprised if by the end of the year, the Fed turns around, not only doesn't do a rate hike, but starts saying, oh, we may need to do QE4. My problem is, hey, they did this last time. They're always behind. The government reacts to trends. They don't create trends, they react. Consumers really drive trends. We can predict consumers. The businesses respond to them, and then the government responds to everything else. They probably will do QE4, but it'll be too late. It takes time for money to move in the economy. It takes time for the Fed to change their mind and look like idiots and say, oops, we were wrong. We thought the economy was being strong and it's weak. By the time they react, it'll probably be too late. And because, again, the Fed is printing money to fight deflation. That's why we don't have inflation. The trend is deflation, deleveraging of massive financial asset bubbles, stocks, commodities, real estate, everything, and debt, massive amounts of debt that have to be deleveraged. Money disappears when you deleverage those loans and financial assets. It disappears. Like $100 trillion out of 230 around the world could disappear in the next few years. That's why you get deflation, less money chasing the same goods. And so they're just inflating to fight deflation. I think that deflation is going to get the upper hand, especially this time around. So that I think they're going to be too late. But I think, you'll be hearing about QE4 probably pretty soon.
Harry, on the millennials, are they changing your guys' models because they're getting married later, they're not finding work out of college, having fewer kids, and from what you guys are forecasting, they're really going to be a generation that will probably be completely devastated by what's to come in the next 5 years?
Yeah, they are. You look at history, generations, their whole personality and view of life gets formed as they're entering the workforce, which they are now. About half of them have entered, half of them haven't. And they're seeing real estate go down for the first time since the post-World War II economy. They're seeing difficult jobs. They're seeing deflation instead of inflation. They're going to have a whole different view than the baby boomers. They're going to be more conservative, like the generation before the baby boomers, the Bob Hope generation that basically were coming of age in the Great Depression and World War II. They are getting married later. They're skeptical. They're worried about having kids in a difficult world, and they don't think like, oh my gosh, the way to get rich is just buy real estate and sit on it. So they're not buying homes. They're renting, and they want to be more flexible in case a better job opens up in Denver than Dallas or wherever they're at. So they're going to be a more of a renter generation and already have been. So, and I'm just getting ready to get some updates. Every 10 years we go through and go more in depth into consumer expenditure surveys from the Bureau of Labor and get like 10 years of data so we can really zone in. And I'm about to get an update, and I'm almost sure it's going to show, yeah, these people are doing everything later.
Harry, I was a Southern California resident. I'm now in Texas, but in Southern California, the middle class, it's quite an illusion, and I just wanted to get your thoughts because I talked to friends who I grew up with, and these people make decent money. I mean, they're making six figures. They're college educated, usually two income families, but their mortgage payments are about $3,000 a month. They got $1,500 in student loans, and it's almost like, yeah, you're middle class. I guess you look middle class, and because of technology, you got a good quality of life. But my goodness, it's almost like is the middle class in the U.S. experiencing some severe dysfunction where they look middle class, they act middle class, but really they're in debt to their eyeballs.
Yeah, they're in debt. They don't have a lot of discretionary income because their mortgage costs and, like you say, their student loans are so high. There's no question. I mean, in California, that's different in Texas. Where the cost of living is more affordable. I mean, $100,000 salary would be middle class because of what it costs to live there. And I was in California till 2002, and I got out of Dodge, man. You know, the taxes, the state income tax has been raised on the marginal level, which I always paid, up to 14% from 9.7. Sales tax is like 8 to 9%, and the cost of housing, even after the correction we had in the last downturn, is at new highs in most cities. You know, LA or San Francisco or whatever, or San Diego. It's crazy. I mean, I'm in Florida. With the savings in just the state income tax, I could buy a second home in California on the savings. Why would I ever put myself as a resident of California again? And I never would. I love California, but I wouldn't even think of being a resident of California with the cost.
Oh, I agree. Yeah, I have 3 young children, 1, 3, and 5, and we wanted to buy a nice home that we would raise them in for the next 2 decades. And when homes near $1 million in California, don't even have central air and they're 1,200 square feet. That was when it's like I'm throwing in the towel. I'm going to a no income tax state where life is a lot better. On immigration, so it's a really big issue right now in the U.S. This election might even be about immigration if Trump continues his advance, which we're still 18 months out. But what I want to ask you, because you are the demographic expert, has, government policy of letting, basically we're just, I don't want to say being flooded, but there's a lot of people from Central and South America coming to the U.S. Does that help or hurt U.S. long-term since the millennials aren't having as many children?
Oh, yeah. I tell you, from a demographic point, culturally, I can see people arguing how immigrants change our culture, and hey, I can see that being the reason. But demographically, it's crystal clear. This helps. Most developed countries are not having enough babies to replace themselves. Only the countries that have high immigration in Australia and Canada and Switzerland have higher relative immigration than we do, and higher quality, more educated and all that sort of stuff. These are the only countries that have decent demographics at all going forward. You get Southern Europe and Germany and Austria and Japan and East Asia, Taiwan and South Korea, where they're having even lower birth rates than us and no immigration. They're dying. They are going to see their workforces shrink 30, 40, 50% over the next several decades. So immigrants, they have more kids and they come in younger, ready to work. The best thing we could do is be more selective, like Australia and Canada, where I said, here's the skills we need, here's the kind of the education level we need and stuff, and force it to be more legal. I mean, but for Trump to say this is the dumbest thing I've ever heard in my entire life, We're going to deport 11 million people. How do you find them? How do you pay to get them back, to deport them back? And what does that do to your workforce and your spending and the companies that rely on these people? Hey, it is true. They came in illegally, but it's also true that we let them. We have not enforced this law hardly at all. So we should start enforcing it now if we want to. But if you let people come in and don't penalize the employers or the immigrants, you're kind of saying this is okay. It's like if you said, hey, pot's illegal, but if we pull you over, we're not going to, penalize you. We're just going to give you a warning sort of thing. So we let this happen. So we should change policies now. Make it more legal. We should find a way that these people can legalize themselves within some reasonable time frame, like 2 years. But to deport them back to Mexico would be the biggest disaster in history. We would have a recession on that alone. So we got to be more reasonable about this. But it has definitely been a plus. The difference between Europe and the United States, why we're stronger than Europe in this downturn, is because we've had more immigration.
Harry, in closing, let's talk some numbers for people just to get an idea. A year from now, is the Dow closer to 10,000 or 15,000 where we are? Gold, if silver, that's a very popular topic for anybody who's investing in precious metals. Silver, because of the gold ratio, is so out of whack, and the silver supply is more consumed because it is an industrial metal as well as a precious metal. So if we could just talk some numbers, looking 3 months out, 12 months out, whatever you're comfortable with, as far as your forecasts look, and sharing with us, what does silver, gold, the Dow, oil look like in a year from now?
Okay, I mean, we're looking at a broader downturn that goes into the early part of the next decade, early 2020s, including commodities, real estate, stocks, everything. But we see the worst correction hitting between now and early 2017. Stocks, again, have made higher highs on each bubble and then lower lows. We've got a megaphone pattern that gives us a target on the Dow by late 2016, early 2017. Let's call it about a year and a half from now, 5,800 to 6,000 roughly. So that's a big drop, 68%. So we'll be closer to 10,000 in the next year, and ultimately I think we're going to go below 6,000 before we get the next bounce. And ultimately I think the Dow is going to go to 3,000 to 4,000 down the road. Gold, we've been saying for a long time, over. We got people out on our newsletter in late April of 2011 told them to sell gold and silver right when silver was at its all-time high of $48, retesting the 1980 top. I think gold's going to end up within the next year and a half, same time frame, by early 2017 at $700, give or take, and then ultimately down the road in early 2020s as low as $250 to $400. Oil is going to be we've been predicting it'll hit 30 to 32 this year, literally in the next few months, and ultimately $8 to $20 down the road. So again, we're seeing everything go down. Real estate is going to take another slide bigger than we saw between 2006 and 2012, probably down at least 40% on average. And of course, that's going to be way more in California and way less in Omaha. Texas is going to be in between because Texas did not bubble much the first time, but because of this fracking revolution, Texas did bubble more on this rebound. So even Texas is going to feel it more. So basically everything down. And again, it's a once in a generation downturn. It's going to last several years, and it's a once in a lifetime deflationary, what I call a reset of the financial system. Debt being washed out, financial assets coming from bubbles back down to reality.
Harry, what is the best actions for people to take right now?
The best thing simply is to convert your assets to cash or cash flow generating streams of income so that you have money, you have dollars when everything goes down. Really, cash is king. So safe short-term bonds. If you're going to invest in anything, buy the ETF, UUP, something like that follows the dollar. The dollar is the safe haven. Not like the gold bugs say. The dollar is not going to zero. We may not be doing the right things monetarily, but we're the best house in a bad neighborhood, and we'll continue to be.
And that's a hard one for people to swallow because, I mean, as you know, you point out all the time the fraud and the lies that comes out of the government, the mismanagement, and then to hold that currency, it's difficult. Do you guys recommend gold and silver? Is it a prudent thing to have some of it as a cash equivalent?
No. The one thing I would have just for barter is maybe some silver coin. I would not want gold. What are you going to do with a Krugerrand? You're going to walk into a 7-Eleven and hand them a Krugerrand to get a loaf of bread? It's not going to happen. No, I mean, gold and silver trade with the commodity cycle. They always have. Commodities peaked in 1980 and crashed. So did gold and silver. Gold and silver are crashing again with the commodity cycle. And, the biggest demand for gold comes from places like China and India. They're slowing down. So no, I don't like gold and silver. Gold and silver, people say they're a crisis hedge. The truth is, and I've tracked it, gold and silver correlate, especially gold, with inflation. That's the biggest single trend, and we're in a deflationary time. So gold's going to continue to go down, and silver as well. Silver's down twice as much as gold. Silver's been down like 80% from the top.
Yeah, final thought, Harry, before we let you go. We really appreciate your time, by the way. And, a lot of my subscribers, have been emailing me, and even it's even touched like my personal life. People are talking about a lot of these September. I guess there's some religious holidays. There's a lot of different things going on in September. Have you discussed this with anybody, or do you have any thoughts on? I think it's I want to say Shemitah and a bunch of things happening around the 15th and the 23rd, and then people say Martin Armstrong's theory. His cycles are predicting a crash. I mean, it's a lot of things coming in September. Do you have any comments or support to back up any of these things happening?
Well, I've heard that guy, Jonathan somebody Khan or something on the Shemitah thing. All I know is we do have a 7-year cycle. If you go back 7 years, 2001, and 1987, you go back for decades, you'll see, something go wrong in the stock market's economy every 7 years. So I think there's something that we also have a 2-year cycle. The 7-year cycle hits this year into late 2015, and the 2-year cycle follows it into late 2016. So that's one reason, among some other patterns we have in stocks, that we're suggesting that, the worst crash is likely to happen between late 2015 and early 2017. So that's, I think there is something to that. But you also see, we've had stock tops, 2000, 2007, and now 2015, about 7 to 8 years apart, and then bigger crashes. So higher highs, lower lows. So yes, the final thing real quickly is that September does tend to be the worst month for stocks. But the truth is that's hiding the fact that stocks tend to start to go down in mid-August and bottom in October and then turn around. So August and October are worse than people think. And this cycle, this what I call crash season between mid-August and mid-October, tends to get exaggerated when you're in a larger downturn or larger cycle. So yes, I think that the highest probability for a major crash is into mid-October on these cycles. And again, a lot of other people are saying that as well. And so again, this is just not the time to be buy and hold. I'll just wait it out. It's better to get out of the way. If we do not see a significant downturn past what we've seen by mid-October, then maybe this whole thing's going to hit later. But there's a high chance that the markets could be down, just like China recently could be down 30-40% by mid-October.
Harry Dent, thank you so much for your time, sir. Everyone, please go to harrydent.com. You can receive a free copy of The Demographic Cliff. You just pay for shipping and handling.